Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go through it, generally related to one, two, three different topics: wealth building, commodities, and/or financial topics. So we're going to dive in there and take a look, see what people are sharing, and I'll share my opinions as we go through it. It's at Finance if you want to follow me, and finding-value.com. We've got a community that we've got over there. We're looking for potential investment opportunities. I'm scanning around. You can follow what I'm doing in this commodity bull market that we're in. We do have a coupon code Mayday that is active, and it's 50% off the first month, just the first month though, on the monthly membership, and a larger discount on the yearly membership for anyone who wants to join for the yearly. So Max Kaiser, and I've got a problem with this, guys. I don't like when people say this. This is what he's saying. Bitcoin is volatile, but you get a guaranteed increase in purchasing power and guaranteed liquidity. Fiat money isn't volatile, and you get guaranteed decrease in purchasing power and guaranteed illiquidity. Really? You get guaranteed increase in purchasing power. That is guaranteed. I don't know, guys. I think that's pushing it, and I would be very skeptical of something like that. But that's just me. Here's another one I wanted to read. It says, "Good morning. Only 1 million people have adopted Bitcoin, those with more than zero point 0.1 BTC. That's 0.01% of the global population. When Bitcoin hits 1% adoption, it will likely be worth around 5 million. And I'm just reading these things. They're popping up on my feed, probably because I shared a tweet in it. I just think that this is ludicrous, guys. This isn't like, if this reverses in the opposite direction, these people could get totally screwed in Bitcoin. It's not used in anything. With commodities, the way that the price is, the way that the price fluctuates, it fluctuates between two different things. In a commodity that is absolutely needed by society to build products, you got the high end, which is demand destruction, and then you've got the low end, which is your cost curves, your break-even points of your high cost producers. And it goes between a shortage, which goes to demand destruction pricing, and then you have a surplus, which goes to the higher cost production cost curves, and supply gets pulled back. It bounces between those two things. In Bitcoin, you have a set amount of Bitcoin. Everyone looks at it from the bullish perspective. Here's a bearish perspective. Well, what occurs and what keeps the price from going down if people want to get out? The supply is fixed. So there's no pullback on supply. There's no need for Bitcoin. What if people leave Bitcoin and never come back? The only way it goes up is if more people adopt it. That's the only way it goes up. It is a Ponzi scheme by definition. And there are things that could wreck Bitcoin. For instance, if you don't have the continual adoption where the price goes up, if the price goes way down, which it very well could in a market condition that I think is coming at some point, what happens when the mining companies cannot make any money? Does the network shut down? And if the network shuts down and they have to charge fees to each transaction, well, what if the fees are astronomical? Remember, something that is designed by humans has flaws. And Bitcoin is a design by a human. It's not gold, which is an element on the periodic table that we use and have found to be, and it's not something that we found from nature and use as a measuring stick for money or currency. This is man-made. And here's another one. This is crazy thinking. Because I'm risk averse, I cashed out every stock, Roth and 401k account, and I'd put them all into Bitcoin. Everything else is too risky. And I just look at this like, what the heck is going on? Everything else is too risky, so you put it all into Bitcoin. Okay? I mean, if that's what you want to do, that's your thing. But I view Bitcoin as very risky. I don't know what is going to keep people in Bitcoin unless the price continues to go up. If the price doesn't continue to go up and there's no need for Bitcoin, where do you think it's going to end up? But Max Kaiser said it's a guaranteed increase in purchasing power, according to him. Guaranteed. So Value Stock Geek, retire in 1999 with $1 million. You take out $50,000 a year. Do this with 100% US stocks, and you're down to $300,000 now. Do it with the permanent portfolio, which is 25% stocks, 25% long-term bonds, 25% cash, and 25% gold, and you would still have 1 million. What I would have done over this instance in 1999 is I would have overweighted and put a whole bunch in gold or silver or something that was down at the bottom there. Platinum would have been a good buy too. And you would have made so much money, you wouldn't be worrying about taking out $50,000 a year. The way that you can do that is you shift the mix. So stocks are fine. I don't like long-term bonds, and I don't like cash necessarily at 25%. You could have a lower percentage. I would rather hold a larger chunk in precious metals and swap those metals between platinum, palladium, gold, and silver. If you had done that in 1999, 2000, gold was the cheap asset. Same with silver in 2000. You wanted to swap to palladium in 2005 and 2009. And then you would have swapped to platinum at a stage later on. During that time frame, I could have probably turned $1 million into many, many, many millions of dollars because palladium from 2009 to 2020, it went from $200-ish all the way to 2,900. And the risk that you take when you're in the physical metals is very minimal because you don't have currency risk, you don't have management risk, you have no risk of getting diluted or anything like that, like tax risks with countries or mining risks, etc., etc. Your risks are very small in comparison to those other things. So that's what I do with a big chunk of my money is I swap between the metals, increasing my ounces of that I have. I should say ounces of ownership of whatever it is, and you use the 4 different metals to swap between them. And obviously, I can give it examples if you guys want to know those examples. I can do that on the website if you are wanting to know that. We're already playing it. Right now, the favorable metal, in my opinion, is platinum. It could also be silver. Those are the two that I really like. Ronnie says, did not age so well, dear Wall Street Journal. Gold is up 50% since in the meantime. And this is gold loses status as a haven status. And that was done on September 20th, 2022. That was actually the bottom because October is when it turned up in 2022. And that's when, so I'll just say this. Do not listen to anything that is basically produced by these financial mainstreams or on the news. You have to basically lose all that because what they do is they have no idea what to write about. They have no idea if something goes up or goes down. And then when something goes down, they use that as a validation as it being bad. If it goes up, they use that as a validation that it's good. And generally what you have is you get negative news at bottoms and you get positive news at tops. And then it just cycles over and over and over again. So when they have these negative outlooks and there's negative sentiment, that's exactly when you want to be buying. But they're telling you that gold loses its status as a safe haven. Couldn't be more wrong. Oh, gotta come back. Here's gold silver. It says, what is your main motivator for investing in precious metals? If an option isn't listed here, feel free to add it in the comments. So protect purchasing power, financial Armageddon, physical asset, price appreciation. So the reason I own precious metals is to get it out of the system. It's a physical asset. Now, if you know how to trade using ratios, then it's also price appreciation. It's also another thing that it protects purchasing power, and it will do well in financial Armageddon. So it's actually when you use the ratios to identify the cheap undervalued metal, I swap my metals into that one. Not all of it, but I overweight the undervalued ones, and you ride it up, and then you swap your weightings based off of the valuation. I'm doing all four of these simultaneously. I'm in a physical asset with the least amount of risk because there's no counterparty risk doing this. I'm under the radar, which, again, it's a physical asset. They do well under financial Armageddon. I'm protecting my purchasing power because I'm not in the dollar, I'm in the metals themselves. And of course, there's price appreciation in dollar terms. So I'm doing all four simultaneously, and I'm creating a portfolio that it's like the ultimate. Now, I don't put all my money in it, but I put a good chunk of my net worth in it. And it deals with the risk reward. Since it has so little risk, I don't need tons and tons of reward for me to do very well. Now, if I swap to the undervalued asset, then I actually increase my rewards as long as I'm patient. Another thing that I think physical metals do that is a positive is it doesn't give you a real-time price value. And it's kind of sitting behind everything out of the system. So you don't see what your net worth is every single day. It rides up and down, and you can swap it looking at the ratios, and there's friction to that swap. I can't just click, buy, sell, and these things are gone. If you're an emotional trader or if you're an emotional investor, the easier something is, the easier it is to get scared out of it. If it's a physical asset, you have to get off your butt, go and trade it at a local coin dealer, which takes time and effort. And in the back of your mind, if something is cheap, you're not going to do it when it's cheap. So there's some friction there that doesn't allow you to become an emotional investor and you just sell out of it with the ease of a click of a button. So there's a whole bunch of positive things when you adopt the precious metals, physical precious metals mindset. And you can use ratios to increase those ounces over time. And what does that mean? I'll just give you an example. I'm going to use 50 ounces of gold to silver ratio and 1 ounce to 100 ounces of silver ratio. So if you buy a bunch of silver at the ratio of 1 to 100, you write it down to 1 to 50, you've ultimately increased or doubled your gold purchasing power. If you bought a whole bunch in the 100 area, you swap it into, let's say you've got 1,000 ounces. Let's say you have 500 ounces, and you swap it to gold. Now you've got 10 ounces of gold. And then if you swap it back to silver, you've doubled your increase of purchasing power if it goes back to 100. So if you swap between 50 and 100, you are increasing your ounces of metal as time goes on. Just as an example, I use all four of the precious metals. I don't use just gold and silver. I use gold, silver, platinum, and palladium. Tavi says, wouldn't it be interesting if inflation bottoms out, but the Fed still has to cut rates to alleviate the government's debt burden? Two words come to mind: hard assets. Totally agree. And here we are doing a retest of that breakout here. Let's rip this thing, baby. Let's rip this thing with inflation. I think that's what's going to occur. I don't want that to occur. I just think it will occur. And I think oil is going to be a big driver of this. Oil is going to be the driver, and obviously gold and silver and platinum and all these things are going to ride along in this big commodity bull market, in my opinion. TikTok boom in silver. So this chart shows silver lease rates. That's the cost of borrowing for traders when they have to deliver. It's currently under the most stress in decades. That's because there are only an estimated 132,000 tons of silver to 198,000 tons of claims. Something is bubbling below the surface here since 2023. And it's huge physical silver cartel stress in this person's opinion. Silver is going to get squeezed here, I think, at some point, and it will be a wonderful investment in terms of risk reward for silver. Here's High Heat. He says, wait, what? And this is about oil. It says, whoa, Friday U.S. gasoline demand hits highest daily level of 2024. Data incoming. So lots of demand coming for gasoline this past Friday. This is for Warren Pies. He said, good thoughts on Rev. It says, bottom line is that policy has grown more pro-cyclical since the great financial crisis. This is part of the MMT vision that doesn't map onto reality. As I understand it, they advocate for fiscal policy becoming more counter-cyclical. They tax away inflation, deficits spend us out of contraction. In reality, policy is always fighting the last war, which makes it pro-cyclical. Of course, it is also pie in the sky to expect legislators to dial the deficit up and down to modulate inflation and growth. And they're using, again, fiscal policy to potentially fight some of this cyclicality in the markets with the real estate cycle and interest rates and all that stuff. Here's Michael. He says, Germany has the lowest home ownership rate. Germans rent instead, keep their life savings in bank accounts yielding negative real interests, and spend a lot for insurances. But then Germans complain about inequality. Folks, if you want to get wealthy, you need to take some risk. And here's the thing that I want to say here. In order to keep your purchasing power, the governments around the world force you to take risk. They force you to become a speculator and speculate in the stock market or somewhere else to maintain your purchasing power. One of the things you can do is just get out of the system and say, I don't want to play your games anymore, and buy physical metals. The physical metal, by buying the physical metal, there's a couple of things that you do. Some people want to buy ETFs. ETFs don't take the physical metal out of circulation. If you buy physical metal, you are taking the physical metal out of circulation and squeezing the entire metal in circulation. That's one thing I like. Two, it diversifies you out of the system. An ETF does not diversify you out of the system. It keeps you in their system. So that's why I think physical metals is a must, because if you keep cash, you just lose your purchasing power. Here's Adam. He says, Allstate's going to increase home insurance premiums by 34% in California this year. We all have experienced recent annual double-digit percent price jumps like this in life essentials. How worried are you that your wealth won't be able to grow faster than the cost of living? I'm not that worried. I think I can beat it immensely because I think I know where this is all going to end up, which is going to be the devaluation of the dollar. So if you get a devaluation in history, what does well under those devaluations? I think precious metals will do well, and I think commodities and hard assets will do well. I think emerging markets could do well depending on what the value of the dollar does. So you want to look at history, you want to see what does well and what does poorly in inflationary environments, and then you got to protect yourself against people who are trying to steal from you through the value of the currency. So that's exactly what I've set my portfolio up for. And there's other things that you can do, like you can set up a dividend portfolio. A dividend portfolio of commodity companies, their dividends go up and down based off of the cost of the commodities. Essentially, inflation is tied to the price of commodities. So if the price of commodities go up and I earn more money from those dividends, because a lot of them pay dividends based off of their free cash flow. Their free cash flow goes up when commodities go up, I get bigger dividends. So I have a inflation indexed portfolio, so to speak, of a variety of different commodities that are inflation sensitive. And my pay or dividend payments go up and down based off of the price of the commodity and the free cash flow of the companies. So that's how I'm doing it to some degree. High Heat says U.S. shale oil declines at an annualized rate of 43%, 11 times faster than conventional oil from conventional sources, says Mike Shellman. The world is sleepwalking its way into peak oil. And that very well could be the case. I don't know the exact timing of this. If I were to guess, it's going to occur in the late 2020s, is where we're going to get the big squeeze. If they print money, the only way that money gets balanced in the system is with increased oil production. The increase of oil production allows GDP to grow. GDP is your income for a country. So if they create credit or they try to do stuff with debt or credit, you need an accompanying growth in GDP, aka oil production or supply, to balance that credit growth out. If you do not get a supply response, which this guy is saying we are sleepwalking into peak oil, you're going to get massive inflation because you're not going to have the supply growth on oil balancing out the credit expansion and growth in the system. It says, remember what bankers told us about money. Gold is money. Everything else is credit. JP Morgan, 1912. Saving money. Everything else is credit. It is debt. A dollar is debt. It's a future repayment. That's why it is a note. Monster Beverage just repurchased 3.1 billion of shares in a single quarter. That's equal to 6.7% of the current market cap. This is what you want to be looking for. Companies that are repurchasing shares, not diluting you, but buying them back. I owned Monster back in the day. It was Hanson Natural, and I owned it when it was Hanson Natural. I also owned it when it switched over to Monster for a while. I made many hundreds of percent gains, but I still didn't hold it long enough. I should have kept holding it even till today. It would have been better. But yeah, Monster's killing it, and this is what you want to look for. Share repurchases. Kobayashi letter says, further evidence that higher unemployment is coming. U.S. consumer perception of the labor market has weakened to the worst level since 2021. The difference between the share of Americans saying that jobs are plentiful minus those saying they are hard to get declined is down to 16.4%. In the previous business cycles, has been a leading indicator for unemployment. It now suggests that the unemployment rate may increase towards 5.5% in the coming months. The labor market is trending towards a recession, in his opinion, and this is one of the worries that I have about the markets, is the unemployment rate getting ready to go higher. And that will or could spur a potential slowdown in the market. And that's something that I am watching as we go forward. The next shoe to drop, Volkswagen is considering unprecedented factory closures in Germany in a bid for deeper cutbacks and another blow to the Chancellor's Olaf Scholz government. Any shutdowns would in Germany during the company's 87-year history, setting Volkswagen up for a clash with powerful unions. Volkswagen may be exiting Germany. It's probably what I would do too. It says, I love the disconnect between commodity prices and equity prices, says Rick Rule. We got JC Parrots. What are you doing with the information here? S&P 500 election cycle versus the current S&P 500. And you can see that the fractals are pretty close. Looks like we could get a little bit of a rollover here historically in the months of September, October timeframe. This is naive. Uh, Imagine playing Monopoly and never buying any assets or investments that generate income. Imagine you just went around collecting $200, giving your money to the rich, and trying to stay out of jail. This is how most people live their lives. And I just went on thinking about that because when I play the game of Monopoly, I try to buy as many properties as quickly as possible with the money I've got. And then I try to build the homes and try to get money from other players. But in real life, not a lot of people do that. And this was just a realization to that. I was like, man, if all you're doing is passing go to collect $200, you're just going to pay all your money to everybody that owns the crap. That's basically what life is. So in Gold We Trust, we've got 71% of investment advisors report having less than 1% gold allocation, while the optimal allocation for risk-adjusted returns is 14 to 18%. What happens when advisors finally wake up? They'll probably buy more gold. That's probably what they're going to do. Bond investors are shocked as a 40% allocation to gold turns out to be ideal when optimized for performance. Read more about gold allocation in our latest special report, which is available for our profile. So you can look at performance, and they're saying that gold, so this is your gold allocation. This is your performance per annum, your annualized volatility, your max drawdown, and your Sharpe ratio. So what we're looking at is we're looking for the volatility to be somewhat lower. We want max drawdown to be, minimized where possible. That's the green areas are the minimum ones, the most favorable outcome. And then the Sharpe ratio here, which is maximized. So your performance per annum, your max return is a 40% gold allocation at 9.75% as your annual return. This would be way higher if you do the swapping of metals to the undervalued assets. I could blow this out of the water. You could add like a 2 or a 3 in front of this. probably a 2. A lot of this, you can outperform Warren Buffett swapping metals back and forth with less risk than Warren Buffett. You really could do that if you're a small investor. Here's a quote here. Above all else, focus on acquiring knowledge and skills. Knowledge and skills are like gold, a currency you will transform into something more valuable than you can imagine, says Robert Greene. And that's all I've got for today, guys. We'll end it there. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you next time. This is Finding Value.